Welcome to TradeTheMBI.com. This is Jonas Reports for the 15th. Well, Friday is action leading into today, Monday, is unexpected. You had the impending attack on Israel, but more of this is just recognition that things are just blah. Is the best way to describe it. It's not great. It's not good. There's more negative than positive on the horizon. Things have been elevated for quite some time. So bulls were really in charge of all this because really the short activity, MBI white is what we look for in that, as well as DOC cyan. They've been elevated, but nothing dramatic. Not any key spikes that usually we look for major pull down. So you look for magenta over yellow, but particularly over 25 as a sign of strength. In this particular case, we broke down below that, and that's when we started breaking below the ABM yellow and been unable to get back above it. That also indicated that we would likely break supports as we came to them. We got to the ABM green, fought back and forth against it, but the other day just literally unable to do it. And even if we hit the 50 at this particular stage under these conditions, wouldn't look for it to hold. We've been below the red line here on the extreme. Shakeout's been negative, and we're getting into an area close to the DOC of a rebound effect. But that may happen if we get down to the 50% marker. It's just a question of whether there's some resilience and wanting to pop back. I think this week also probably think they get the Bitcoin halving takes place. That'll be an interesting one in Hong Kong, and then we're going to approve additional ETFs. So will that be the boon for that setup? Yeah, we'll see later. A little bit different when you look at the NQ, MBI white, a bit stronger, almost at the 25 level, holding just right below it, with magenta having dipped down below. So it's really going to be short-term buyers that are going to be needed to sustain things. Better improvement from a DOC, but it's also a drawback because that improved DOC, opposed to what we saw from the S&P, means the needed boost may not necessarily be coming from the Nasdaq. So where are you going to get it from? Uh, the broader market really going to rally all that much. You've got problems with a whole lot of sectors. Not a whole lot of excitement from that goes. Rates also at the higher end of the range that they've been at for quite some time, since going back to November, and it's still too low relative to where we're at. But there's still that holdout hope that Powell's going to cut into inflation, because this is your inflationary key right here as we watch oil. And this is sort of that precursor. You see bonds late to the rise in oil. We've seen it from other commodities as well as currency, because at the end of the day, what currency you got to flip into to buy oil? And it's not the euro. So the fake pump was all they could do to hold it, and then everyone else was clearing out because they knew that the Eurozone was going to have to shed all those euros in order to get oil. And it costs more and more. It takes more euros. That's a bigger drain. And it's still way elevated anyway, but that's for weeks to come. And that's going to depend on what happens here, because gold continuing to make new highs. The reason why it won't continue to do so, yes, there was a lot of selling, so it faded off a little bit, but still remained above its previous high and made a new high, and likely to continue to push towards doing that. There's just no abatement, because there's no reason why you would stop wanting to get into commodities at this particular stage. You have no desire from the Fed to be firm on inflation, and you're printing an extra $1 trillion every few months. Uh, Tell me, it's any economic model. I mean, you really don't have to be a genius to figure that one out. It was just a question of how long they could go before it started to spiral. And we talked about this, well, a year or more ago, that they would reach that point where the acceleration of the decay becomes greater than their ability to manage it. In an election year where nothing is going to happen, this is really bad timing from all those aspects coalescing all at once. Bitcoin faded off just a little bit. It'll be interesting to see how it handles that halving, because again, that they look at it from a supply standpoint that cuts half the supply, but it also cuts half the monies that miners make. They keep the network running, and the only way to cover that is for price to increase. So if price doesn't increase, miners take a hit. You reduce the number of people who are mining bitcoins, and it's an interesting little circle of events. But typically, that halving usually leads to extraordinary burst. Now, of course, some could argue it's already done that because it's gone from the mid 30s to 70, which was a huge boon right there. ETH a bit weaker, and you can see already it's 50%. Unlikely to hold that range at this particular stage unless there's a significant buy reversal. So you might see more pressure, particularly if the market's under pressure. I think that's going to be clear. So what you see is a nice, clear indication of declining higher, highs being made over successive days, and then lower lows being made each day as well. So lower highs, lower lows. Sounds like a downturn to me, or at least some modification. It's just not significant when you're still at over 5K for what we're seeing. And you're starting to see the pressure that's under a lot of the earnings reports where they're talking about the significant difficulties that are heading up. We saw the ridiculousness with job numbers where it's all part-time and it's mostly from the new immigrants that are coming in. You get a continuation of layoffs state by state that are pretty enormous, recessionary. It doesn't show up in the federal numbers for unemployment, durable goods, producer prices. They just arbitrarily make changes, where they just decide to estimate as opposed to using the actual data, because the actual data is not pretty at all. So that's the long and the short of it for now. As always, though, we're just going to keep plugging away with what we've got, and the sell signal's pretty clean. Everything's fairly straightforward from an intraday standpoint. It started off in the Asian session and then bled through into the European session, and then by the time we got to the US session, it was just a continuation of it. Still remains to be seen whether Israel retaliates to the Iranian attack. That could create further pressure and unease, and also be a spike on oil. Just depends on how that goes. I think the market would see it as bullish if Israel decides not to do anything, but I don't see how they can afford to not do anything, because missiles got through. They have fewer defense systems. I think the Iranians could probably send missiles every other day in that kind of quantity because they're making them cheap and inexpensive, something they learned from the Russians in the war with Ukraine. That's just a degradation situation. I don't think anyone can suggest that they can defend indefinitely under those kind of conditions. So the only thing you can do is go after the launchers that are launching them, and that's an escalation. Escalation means conflict. Conflict means potential for the U.S. to get involved, and that's ugly for oil and everything else. So there you have it. Geopolitical jumping in right at a time where soft numbers really exacerbating the situation. It's going to be some precarious days ahead. As always, though, anything relevant, I will get it on the Skype chat. Have a good one. You're prepared. Take care.